got the mortgage, the partner, the income, and some basic investments. But if you're still running your finances the same way as you did as a resident or intern, you're unfortunately a little bit exposed. In this episode, we're continuing our multi-part series with Roger, a financial advisor with over 25 years of experience helping doctors manage wealth, risk, and long-term planning. This time, we're focusing on the mid-career stage. When your income is getting higher and higher, your responsibilities are stacked, and small financial mistakes can start costing large figures.
When it comes to the word risk in the game of investing, risk is misunderstood. Risk is more like time frame. What is my time frame of investments? If you put money in the stock market for 1 year, that's risky, which it is, because the time frame's wrong.
We use risk as a general term that represents a lot of things depending on the context we're talking about. You only want to put your capital in for 1 year, and it's high risk to do that in the stock market.
That's correct.
The risk means that you might not get all of your investment back. That risk is really a function of volatility. Here's what we'll cover: how to avoid the most common mid-career insurance mistakes doctors make, especially as your income and liabilities grow; how to manage financial harmony with your partner, including bank accounts, lifestyle balance, and navigating some financial tension that invariably exists; why diversification strategies and investment structure matter more than ever at this stage of your life, especially if you're heavy on property and light on everything else. If you're a doctor in your 30s, 40s, or 50s, this episode will help you avoid some expensive mistakes and start thinking like a future-proof investor and provider. Now let's get into it. Hello, everyone. Welcome back to another installment of the Investing for Doctors podcast. Today we have the second installment of this 3-part series on sort of the role of a financial advisor in one's life. And we have Roger back with us today. Welcome back, Roger.
Thank you.
All right. So in the previous episode, we sort of talked about the early career stage of a doctor's sort of life and the importance of getting insurance set up, reviewing your habits and spending pattern, and setting the foundations up to get to sort of mid-career where you start earning a lot more and you start also having a lot more complexities in life, as well as the potential for the financial advisor to really assist the individual and the family in on their investment journey.
Yeah, well, that's right. We did start out on, as I like to call it, laying the foundation, which insurance is very, very important. But as you say, the midlife part of your career and your life, like when I guess, as you said earlier, when you get married, get a mortgage, start to have kids, then you've got the next, say, 18 to 20 years of looking after the kids and trying to build wealth and trying to build your career all at the same time, which is very challenging. So that's when, you should start outsourcing some of the more intricate parts of your financial structure to make sure that you've got things right, on the right track, I should say, heading in the right direction. And that's when you should really start to talk to an advisor about what your goals and objectives are. Obviously, you want to look after your kids and all those types of things. And, it might be things like, do you want them to go to private schools, because that costs. Things like that. And then, then as you get through that, you go through those 20 years, you're going to have some ups and downs with your children's health, hopefully not. And there's costs involved with all those things and potential health issues with yourself. And then, as you start to look at your parents and start to see them getting old too. So you realize you're not immortal.
So I guess we'll sort of tackle each one of these issues one by one. Right? I mean, the first thing is we're going to hop on about this, making sure your insurance is up to date, because as you get more assets, you upsize, you may need some more insurance to cover your liabilities and also your kids' education in case yourself or your partner both pass away in unfortunate incidents.
Well, hopefully your income's going up.
Yeah, well, it is. So you have to cover that as well.
So you have to make sure you got that covered, because as I said, that's the ATM. That's where the money comes from. So you want to make sure that as your salary significantly goes up, which I assume it will and does, that you keep up with that. Because they are indemnity policies these days, and that's the importance of reviewing it, because you could be it's not unusual to be earning double, 3 times of what you started, 4 times of what you started on, and you could be significantly underinsured.
Yeah.
And it might not cover all those costs that you think you are covered for if you get sick. So you need to review it. So I know we do harp on about it, but yes, it is very important to make sure you, the ATM or your ability to earn income is covered.
Yeah, well, it's it's the first of the 5 Ds I also mentioned, death and disability. And I guess the other third thing really comes into play, sort of that divorce thing where, if you're married, make sure you get your relationship sorted out right. And that's a hard topic to talk about because as you alluded to earlier, you've got kids, you've got your career ramping up, you've got aging parents, everything is happening at the same time in midlife. So got to spare
liabilities.
Yeah. So you got to spare some time for your partner as well because they're going through the same thing.
Well, there could be inequalities there, inequities there in the sense that as we spoke about earlier, if the male or the female stays home looking after the children at one time, then the super has potentially, because it's a percentage of your salary that goes into super, as we know, currently 12%, they can get out of whack and they won't still be the same. So someone might have the one who's been working for the longest and didn't take time off to look after the children would potentially have a bigger super balance. So on divorce, if there's a significant change in there, you might have to go to the family law courts to get that, if back onto the divorce, to get some of that money out of that person's super fund and back into the others for equality. So it can be messy, but again, there's no insurance for in divorce.
No.
But, you just got to make sure that you're aware of all these types of things. And you obviously know you need lawyers, which you need lawyers.
Yeah. Well, sometimes you don't. They're very rarely you don't.
Yeah. Well, if you,
But I guess the question I want to ask for you, where you can help, is that what sets because finances is often a topic that comes up in arguments and family disputes.
That's one of the major ones, isn't it?
Yeah, it's one of the major ones. Apart from that, it's like, responsibilities. That seems to be the 2 major ones that I guess both people can work on. I mean, infidelity is probably another big one, but that's really not something you can communicate with your partner about, apart from making sure everyone's feeling validated, heard, and that sort of thing. So, let's approach that relationship from the financial aspect. What are the things you would like couples to be doing to, understand each other on their financial journey and on their investment journey? Because there's often a disequilibrium between 2 individuals, especially if one is out earning another, and they have different habits, spending habits, lifestyle habits, and also approach to risk and investment.
Oh, this is a pretty common sort of concept where, I've learned this through my marriage as well, which I've learned that through life, and not necessarily being a financial advisor, is obviously, your spouse should have their own bank account. You may have a joint bank account if that's the way you want to do it, a joint bank account, and where expenses come in and out and what have you. And then have your own separate private accounts for your own spending and allocate that to yourself. So you don't have to feel guilty about buying something that you want to buy or ask the other spouse for something like that, which can, again, that leads to arguments around finance. But if you do structure where they have their own bank account and you allocate how much your budget, how much you should be putting in that joint account, which should be an offset account against your mortgage.
Yes.
And then putting the surplus in your own personal accounts and buying what you want to buy to keep yourself happy, not have to ask for approval. That's one big thing that I've learned that you have to do, and it's a pretty common thing. And obviously, understanding this when you got the joint account and understanding the spending habits and what have you. I mean, the father walks around the house turning all the lights off, saying the kids leave the lights on, turn because they're going, why? Well, it's because we've got to pay electricity. It's understanding what your habits and the kids got to understand that as well. So again, with the cash being not as prevalent as what it used to be, you sort of lose the value of cash and money.
Yeah.
Because of the kids just see us tap.
Yeah.
And again, getting back to that with your kids, there are programs as you might know in schools where kids can get cards and they see their accounts and all that, and see the money coming in and coming out.
Yeah.
Which again, I don't think is as good as cash, but at least there are people trying to address those types of things these days. So that's simple, basic sort of things. And again,
They're not always done right.
No, and it's getting that. It's all, it's like everything. It's all about your frame of mind.
Yeah.
And, to do anything, like to become a doctor, become an athlete, you have to be dedicated and focused and want to understand what you're doing. And that's why education such as programs as Jessica Brady is one of our partners, seminars, reading books, getting involved, talking to people such as people in the IFD Facebook group, is getting that basic understanding and just being open about conversation with your spouse about your spending habits, what you like to spend money, and have that calm conversation. I've been with my wife for 17, probably nearly 18 years, and early on I wasn't aware of those things you needed to be aware of dynamics in a relationship around money, because you hear people saying it's one of the biggest causes of divorce is finances.
Yeah.
And then luckily we've come through understanding now and understanding what each other's needs are. She needs her bank account, I need mine.
Yeah.
We pay bills here, and then we discuss big expenses and work through and educating each other. Well, in my case, I show my wife through teach her cash flow. Not that she needs to be taught, but if she sees it in a spreadsheet, when I say money in, money out, and we put an expense here, what is that going to do down the track?
Yeah.
Future cash flow. So it's just simple things like that.
Yeah.
You just get a spreadsheet and just start a money in, money out, and you'd be surprised how easy it is. You can start
to communicate that.
And communicate that and see where money's going. And if you engage each other like that, and not to be overpowering, but just engage and both exploring that. It makes the relationship a lot better, a lot more calmer, less friction, and you still have your freedom to buy what you want to buy without permission.
Yeah,
because that's a big killer.
Yeah, especially when there's the sole breadwinner scenario.
Yeah, and again, when it comes down to that, is valuing the other person, as we spoke about earlier. The value of staying home, foregoing what your aspirations for a period of time, even though kids are not aspiration, aspiration, but you want to have a family. But the value of and the work that goes into staying home and looking after the children and running the house and all the little errands and all the things, that's a big job. It really is a big job. So the spouse, the income earner has got to recognize, because you leave, go to work, come home. You don't see what they do. You really got to understand what they do and the value of that. I learned that throughout my marriage. I saw lots of video when we first had our child. I saw later down the track, I saw lots of videos of during the day that I'd missed because my mother had been over, the mother-in-law had been over, and my wife see them playing with the baby, and I'm thinking, I didn't see any of that. I didn't know that's what you did. Because when I went to work, you're out of sight, out of mind. I come home and there you are, and everything's done, and I didn't sort of stop to think of how much goes on until I saw some videos later going, wow, it's 24/7.
Yeah.
You don't get a break, especially with babies.
Yeah.
So,
so I guess it's that appreciation.
Yeah. You really got to understand the value of what the other person does.
Yeah. So, now that we tried our best to mitigate that third D. So obviously now you're, our doctor is like earning a lot more money, has a bit of cash flow that they can start to choose to invest in. And most people in Australia, they like to get onto the property ladder, through the owner occupied or through a couple of investment properties. That's relatively, straightforward because a lot of people feel like they have a grasp of it.
Yeah.
But
it's a default position for Australia.
It's a default position. Yeah.
And there's nothing wrong with that.
There's nothing wrong with that. It does annoy me sometimes because it's, I find it a bit boring, but there's a lot of interesting aspects of it. But I think if you just went that one strategy approach, there's been a lot of people get very rich and very wealthy off doing that.
But compared to what?
Exactly. So then I guess, once you have a handful of properties, some people just get bored with it, or they say, I'm overloaded on this. I want to do something else. Yeah. But even before that stage, there is a value of having an advisor, because even though historically most advisors don't go down that property pathway, because of the aforementioned sort of, you don't really get any sort of
we can't recommend. We can't recommend.
You can't recommend. Yeah, as in you can't recommend a product. Yeah, exactly, because that's not a investment product per se.
Not per se. That's exactly right. It's not listed as an investment product.
Yeah, but obviously to give comprehensive advice, that can be part of investment strategy.
Yes. Oh, yes. Yes. It's strategy.
So the way the way that we have historically seen is that property is often forgotten, or not really forgotten, not neglected by financial advisors because, it's not a product. It's nothing they can extract value out of previously because, everything used to be commission-based, fees under asset management. So you can't extract anything out of that. So there was no interest in doing property. But obviously, we do things differently. We're sort of a fee for service based, so it doesn't matter. If you want property, it's fine. You want stocks, it's fine. You want to, invest in any other assets, and it's also fine because you're not tethered to that. So I think that's a better model.
You hit the nail on the head when you said there's no funds under management or percentage funds under management fee structure with direct property. Just quickly, we can recommend property in the sense with listed property trusts, which invest in commercial property because it's unitized and it's a licensed MIS, managed investment scheme type of thing. So we can do that, but not direct property. But again, getting back to what you're saying there with property, you can be overweight, obviously, in property, and as you say, it can get a bit boring. But some people get rich from it. But again, coming back to the way we provide advice, it's just all fee for service. So again, when we're providing a statement of advice, we look at everything. We make sure your foundation's in place and it's up to scratch, which is your insurance side of things, your personal insurance side of things, and then we look at your cash flow modelling. So we can sort of like assist you with, not sort of like, is what we do is cash flow modeling, where we can say, well, these are the figures that you need for it to work, in the sense that, like, here's your budget. You can afford a $600,000 property. Move on from that. $600,000 property, and you need roughly a yield of this, and this is these are the numbers. They're just the numbers. We don't care if it's a red door, green door, blue door, purple door. That's where you have your buyer's agents. Or if you think you're up to scratch and got the time to research all these properties on investable properties on the market, good luck to you. But I myself have used a buyer's agent for a property I bought in Adelaide because I don't have the time to look at 355,000 properties on the market at any one time in a day. So that's what they do 24/7. So again, we come back to the structure side of things. So you go to a buyer's agent, but we will say, okay, in our statement of advice, so your insurance is right, the structure is something we can recommend the structure on. But these are the figures, our figures, the figures that you need. So a buyer's agent their job is to find a property that will actually fit those figures. So we obviously disclose clearly in there that no, we cannot provide recommend or choose investment property. It's totally up to you, and or we will refer you to a buyer's agent. And that's where you know that your cash flow is right, and then you left it up to another professional to make sure you pick the right investment. If it's not stocks or whatever we do, bonds and all those types of things, then that's where we get no problem doing that, if that's what you want to do. But at the same time, we'll make you aware of the pros and cons and all those types of things, and different life stages got a lot to do with it, and the structure again, as I said. So, if you're a high income earner, property has its place where, if you get a new property and it's in your name, you can use a depreciation, all those types of things, and not necessarily the negative gearing. That's not the big one. It's depreciation is the good one. But again, it's all about your life stage, and then you may want to look at and the structure. You may want to look at sort of offsetting that risk as well, if you want to call it risk, which we can talk about another time, which I don't particularly like that word, of having some other assets such as shares as well, and bonds and all those types of things, because the old saying, don't put all your eggs in one basket. But again, property has its place because the banks like lending money to it for it, because it's see it, feel it, touch it, and they know the stats around the postcodes and all those types of things. So,
and people talk about it all the time.
It's something people are comfortable with because they can see it, feel it, touch it. But again, so when it comes back to what you were saying, it doesn't make any difference to us. The fee structure is the same because you pay for a fee for service or professional advice around the numbers, structures, all those types of things. But if it's a property, if you think you can do it, I wouldn't advise it. But that's where our advice stops. Then you go to a buyer's agent, what have you. Then we can work with a buyer's agent and what have you. It's traditionally advisors didn't like it because they couldn't make any money out of it because it was hard to charge fees, and I'm talking a long time ago. But now
the model's different.
The model's totally different, and I remember in the early days, it was hard. The industry was quite young. It was hard to sort of like justify and value yourself with what you really knew and the value you could provide. But after doing it for so long, you can see the value that you provide, and I should be paid for my experience and what I'm imparting to you and what I'm doing for you. Just as a doctor, it should be rewarded quite well for keeping you alive. So doesn't bother us. It's if you want, but again, we'll say down the track, and then as the relationship progresses, you might say, okay, I want another property. Okay, fine. But here's some more education around why we should look at diversification. Here are the facts around it. But then it's like leading a horse to water. You can't make it drink. But we can tell you what the pros and cons are.
The pros and cons and the
and the
structuring.
outcomes.
Yeah, and the outcomes.
Potential
the
outcomes.
The modeling of the outcomes. And what that looks like in 20, 30 years.
Yep.
Yeah.
And what it allows you to do, leverage off. I mean, you can leverage off a share portfolio, but it's easier to leverage off a house, a property, because banks are so happy with that. But you can do it with same with share portfolio.
Yeah. I've actually seen some individuals leverage off like a bonds portfolio, which is
it's called margin lending.
Yeah, you can definitely do that, and there are very sort of specific and sophisticated lenders that will lend to that at also very good rates as well.
Yeah, and on specific types of bonds, as you were saying, A to triple B or whatever, and on specific stocks, they have like an LVR or a percentage that they will lend against it straight away, so you know. It's just like banks with houses. I don't know if people know this, but banks, when they're lending for a property, they look at the postcode and they see how overweight they are.
Yes.
In that postcode, how much Commonwealth Bank has lent, or they've got on the books in that postcode, or Westpac and what have you. So they look at their risk too.
Yeah.
So and they like to diversify their portfolios when it comes to property of different states, different postcodes, and they're not stupid. So let's do the same sort of thing.
Yeah, absolutely. And I'm an angel investor in startups, so like I would be overloaded on that, for instance.
Yeah.
Because I like that and I understand the risk. So, and everyone has different sort of approach to this idea of risk.
Yeah.
But the way that I look at risk might be different from a usual person. So this topic comes up a lot when we talk about diversification, and Roger, I'll let you have the first go, then I will share my thoughts on that. Yeah.
Yeah. Well, let me just start. It's because you're educated. That's why you can take more risk. Is because you understand the pros and cons and the tips and tricks and traps that can happen, because you got yourself educated and you got experience. So that's that education pathway where you can get more sophisticated because you understand. But when it comes to the word risk in the game of investing, if you want to call it, from my point of view, is, people say we can take more risk or higher risk portfolio. Well, what does that really mean? Because if I usually show clients, always show a client a Vanguard index chart, which anyone can download and have a look at, which shows you, it's a 30-year chart, which shows you what the indexes are. When I mean by the index, I'm saying what the All Ords does, what the Dow Jones do, what the Australian bond market's done, and listed property, and what CPI and what cash are done. Right. So it says in 1994, for the latest one we've got, 25's not out yet. If you invest $10,000 in 1994, and invested any one of these assets, like the international shares, so they break it up, international shares, US shares, because the US represents 52% of the world market. That's how big they are. We're at 2.5%, by the way. So there's Australian market, then there's Australian bonds, a listed property, and then cash. And it says, it just shows you it's growth. You reinvesting in dividends and just compound, leaving it, excluding taxes, because it's different structures. But anyway, it just shows you and sees the characteristics. So if you get to June 30, 24, it'll show you the volatility, which is the characteristics up and down of the stocks that do this. But you can see they always go up. Then you'll see the rest of the stocks, top markets do that. Then you'll see the bond markets go up just a little bit like that, volatility, right? And then you'll see cash, nice line like that. Then you'll see CPI, another line like that. Now, I'm 30 years old and I got superannuation, which I would have if I'm working, and I left. I knew nothing, and I thought, I listened to all the horror stories of the markets and what have you, and I just panic, and I had all my super in cash.
That was terrible.
And left it for 30 years. That now cash, and I'll tell you, $10,000 is $34,000 now. That's what it is now. 4.2% is the average, according to these charts, and this is historical fact. So now cash has become risky. So there's a risk. Cash, people go, cash, risky? Yes, because you've just risked not having enough in retirement. You got $34,000. Now, if you had invested that same $10,000, just for example with this chart, in the US stock market, $235,000 for that 30-year period. But because it was in super, you could the markets go down and do this. But really, if you've got a 30-year period and the markets always come back, what's the risk? But it's a different story when you've got money outside super. So to me, risk is misunderstood. Risk is more like time frame. What is my time frame of investments? People know the simple fact, like if you want put money in the stock market, they know this. Whether they don't know anything about investing, they know if you put money in the stock market for 1 year, that's risky, which it is because the time frame's wrong.
Yeah, I think we use risk as a general term that represents a lot of things depending on the context we're talking about.
Yes.
When we're saying that you only want to put your capital in for 1 year, and it's high risk to do that in the stock market.
That's correct.
The risk means that you might not get all of your investment back in the same time because it could plummet, it could go
up, it could
go up, right?
Yeah.
So it's really a function, that risk is really a function of volatility. And we were saying it's volatile because if you actually need that money at the end of it and you cash out, you could be cashing out at a loss. So, I mean, the historical idea of risk is basically going to, the casino, and what's your risk of losing your money, right? It's a risk of it's a all or nothing approach.
That's a 99%
what is the percentage?
Risk
Yeah.
loss.
So what is your percentage chance of losing everything?
Yeah.
Right. But in this day and age, if you invested in an index, a diversified index ETF, the risk of losing everything is zero, essentially.
The longer you leave that investment, the risk peters down. This is like you got your axis and your scale here.
Yeah.
This is high risk over there. And this is the time scale. The longer you leave it, your risk of losing just peters off like that. The longer you leave it.
Yeah, and I think what I like to look at it is what is the chance? Risk should be viewed at what is your chance of not getting back your principal in a specific time frame.
That's correct.
Right. So in the short time frame, the risk of you, the chance, or not use the word risk, the chance of you cashing out whatever you invest and being sure that you do not lose your principal amounts. Let's not talk about any gains. Is higher in stocks than say the bond market, but it doesn't mean that bond market is lower risk because if there was
what are the outcome you're looking for?
Yeah,
that's
what is
when the risk comes.
Yeah, exactly, right? So if you, for instance, if you are saving up for the house deposit, which you need in a year's time, you wouldn't want to put it in stocks because there's a reasonable chance that the moment you need it, the value could be less than what you put in.
And that's where you lose.
Yeah, whereas if you put it in the savings account and you earn some interest,
no risk.
There's no risk to that end.
Losing capital. No risk.
Yeah, there's really no risk of losing capital.
Correct.
In that instance.
Yeah.
So it's whereas over 30 years, the risk of you losing your capital on a broad-based ETF is
virtually
negligible.
Zero.
Is negligible. Yeah.
The longer you leave it, the less it is. Yeah.
And so and the risk of putting in cash is that you're not earning enough money on your investment, and that is
for the desired outcome you want it to do.
Well, for that time frame, right?
That's right.
Because the risk is you're losing upside.
Yeah, and again, so when I say I don't like the word risk, you're right how you say it the way it is used, but when clients come and see me, I always go through that chart to explain to them exactly what risk means. It's volatility, as you said. What's the volatility I can put up with or I can handle for the time frame I want to invest? Pretty much equals risk. But I don't like to explain because risk infers fear straight away.
Yeah.
It's more of an understanding. You got to learn. That's why we advise, again, getting your education advisors, reinforce the education that we provide you and you've got, is to understand that your time frame.
Yeah.
Like I said, I got retirees in balanced portfolios, which is a 70% growth or 30% defensive, but we've still got enough in the 30% to outride that longevity of that growth portfolio. Because like I said, statistically, it's minimum 7 for a high growth portfolio to minimize your risk. There isn't ever zero, but to minimize your risk to pretty small, it's generally more than 7 years. All right, and especially with super, depending on your age, you got much more than that. And again, when you get to 65, you've still got statistically
20 plus years. Yeah.
So you really got to understand the volatility and what's that capital designed to do for you?
Yeah.
So that's my bugbear, but I'm glad we got that out because I want people to really understand that.
Yeah, because the way we understand risk in medicine is that what are the chances of a bad event happening?
Same sort of thing, yeah.
And when we invest, the bad event could be I lose all my money, or it could be I can't get my money out when I want it to.
That's right.
Which is liquidity, or I can't get the value I want to realize in the time frame I want, which is the volatility aspects.
Correct.
So it's we're talking about different things depending on the context.
Yeah, depending on the context, yeah. But it's just generally speaking, when people say, oh, high risk, high return, or high risk, hang on, let me just break it down for you.
Yeah, it's actually not really high risk. It's just it's
a high volatility.
It's a high volatility.
Or zero volatility.
Yeah.
But then on the time frame. What comes out the other end?
Yeah.
Is the returns. And So that's why I never get calls especially when Donald Trump introduced the tariffs.
Yeah.
The markets came down.
Yeah.
I had no one worry because I'd educated them to tell them that it's not going to last long and you've got this time frame to outride this.
Yeah.
And of course it turned out to be a great buying opportunity.
Yeah. Absolutely. Now, we talked a bit about diversification and probably the need for that. I think at that sort of mid-career stage, you probably don't need to diversify, the risk profile, but you probably want to diversify the type of assets you own, because different assets have different liquidity characteristics, how easy it is to cash out and all that sort of thing. And the structure you're investing in also has that characteristic.
Yep.
If you're investing in VAR Super, then you're not going to cash out for many, many years. Whereas
depending on your age.
Yeah, depending on your age. But and that liquidity thing changes as you get older and older, or
the awareness of needing it.
Yeah, and closer towards retirement. So someone who's 60 versus someone who's 40, super is a completely different structure for those mindset, and a different mindset as well. So I guess that's also the important part of where the financial advisor comes in, is education on those things and managing that over time. And again, none of this stuff is static. It's a living document, living process,
living, breathing beast.
Yeah.
Again, with that on the when I was talking about that Vanguard index chart, and I encourage people to have a look at that. It's fascinating and it's just great to look at, and it just reinstills that type of understanding. So if I remember I look at it all the time because it's above my desk. With the US market, this is just that current chart, $10,000. It's 11.1% equals 235,000. It's 11.1%. Then the next one down is the Australian share market, which is 9.1%, 2% difference, and that's 135,000. It's only 2% difference. Yeah. That's the magic of compounding and how much you could miss out on if you've got a balanced or a conservative portfolio. When you've got more than 10 years, say, or 15 and pushing it 20, whatever, that you're missing out on just 2%. Because the difference between a conservative portfolio and a growth portfolio can be more than 2%. But look at the outcome at the end of the day after the longevity of that and compounding. 2% difference, nearly double of what that value of that portfolio was. I think it's about 250 or something like that for the US market, and 135 for Australian, when it's only 2% difference.
Yeah, it makes a huge difference at the end.
Massive amount of difference. So getting your portfolio right at the right age is make the massive difference.
Yeah, and one of the criticisms that I have of the sort of Australian super system is that we're actually very overweight on Australian equities, in all of the high growth assets.
Well, yeah, when you're talking about the growth assets between shares and Australian equities and international equities, and when I mentioned earlier that we're only 2.5% of the world market, and the US is 52%, and yet we invest up to 40 on a high growth. We're going to invest like 40% or 45%. Some portfolios in the Australian market. Why do we do that when we're only 2% of the market? Well, I'll tell you, a big reason is dividend imputations. That's what Paul Keating brought in, which is, I'm sure a lot of people understand what that is. It's like, I think we've talked about this. Credits. Franking credits, if Woolies gets their profit and they pay their 30% tax, and then the rest left over, they distribute that to you and you get taxed in your name. That means you're being doubly taxed. So you got a 30% credit back on what they've paid for you, what Woolies had paid. So you're not double taxed. So there's one of those little things that people don't realise what the government's Paul Keating did to make sure you're not double taxed. So you get that credit back. So, and that's one big, they don't do that anywhere else. That's why we do heavily invest in the Australian market because of that, because it's very valuable, especially for retirees. And in I know jumping the gun, but in retirement phase, when there's zero tax rate, you still get that money back because you shouldn't have paid that 30% tax. Because that's owned by your pension fund, which is zero tax environment.
Yeah. So, I mean, that's also the thing about at different stages, you could perhaps rebalance the portfolio to a different, a more dividend heavy approach. That's probably more heavy on the ASX 20 rather than the ASX 200.
Correct.
To take advantage of those dividends.
Funds.
Yeah.
Because you're relying on the income. You want your capital to last. And you are relying on the income. So you want income generating, which again, and the tax credits gives you more income.
Yeah, absolutely. So I guess in this family, we've got the kids as well. So, you want to also plan for the kids' sort of future. And there's obviously different ways of doing that, investing in their name or investing in family trust so that they have a little, pool of money for their university or whatever. I mean, it's first world problems. Yeah.
Or the property in Alice Springs because they won't afford it here.
Yeah, exactly. I mean, for myself, we already have the units that my kids can potentially live in and later down the track.
Again, you educated yourself on this.
Yeah, but that was a very sort of conscious decision because I know the housing market is getting out of is going crazy, and
all the capitals actually.
Yeah, and the more I look at it, the more hopeless I feel for my kids because they're gonna have even harder time getting on the property ladder, and perhaps there will be some seismic shift in the mindsets of people that it's okay to not own your own home, it's okay to rent longer, and I think Labor's put in some legislation in to make it harder to evict someone so you can actually stay in a place longer and have that security of being a long-term renter. Yeah. But still that's not a good feeling to have to know that you could be kicked out anytime.
No, well that's I remember a speaker many years ago talking about that. The problem with that in this country is we only have 6 to 12 months retail properties, 6 to 12 months leasing agreement terms. Contracts. In the UK, they're up to 5 years.
Yeah. Absolutely.
So you can have that certainty of knowing you're not going to get kicked out or whatever. Yeah. So there will be a seismic shift, as you say, I believe, in this country because it's just out of control.
So why don't we have? I mean, you may not be the right person to ask, but why do we not have 5-year lease agreements for residential?
You are right. You're probably asking the wrong person. It should be one of the property agents.
Guys, talk about it. Yeah.
But having said, the common sense would obviously be so it's favoured towards the landlord. So they can push the rent up every time unless it's in the 5-year contract, get new tenants in. I really couldn't answer the history of that. That's where you have to talk to one of the other guys about that. But just common sense, I'd say it's heavily weighted to the landlord for that reason. Which, again, it's poor renters. They've got uncertainty.
Yeah.
They can't put their roots down.
Exactly. So, I mean, that's another thing that we need to think about the kids during that stage of life, and as a financial advisor you can probably advise them on sort of the structuring so that when the kids come of age they could have access to either some funds or some additional help from mom and dad that they can then take over without triggering capital gains tax and all that sort of things.
The bank of mum and dad. Well, there are different structures. I mean, without getting too detailed, yes, there's insurance bonds, education bonds, all those types of things. But if you start me on that, I'll keep going. I know you're aware of them.
Yeah. So there's lots of things.
There is family trust and all those types of things. But again, there's different sort of stamp duty regulations for different type of trusts and so
and different jurisdictions.
You really got absolutely different states. So you got to understand again the characteristics of the different types of trusts and how they're owned and the assets in the trust and all those types of things. But they are good for asset protection. That's what people think they're the best. They are good for that. But again, generally you have to provide a personal guarantee for things anyway. So it sort of almost negates having a trust because people, to make that make sense, is no one can own a trust, which is hard to get your head around. You cannot own a trust, but a trust can own assets. So that means you own nothing, but you control everything. So people thinking, how does that work? Yeah, it takes you bit to get your head around that you cannot physically own a trust.
It's like a piggy bank in the sky that
You
will
cannot,
then, then
but you can control that trust.
Yeah,
What's in
yeah,
it?
yeah.
So the idea behind that, if you get sued, I don't own anything.
Yeah,
but you've
yeah.
given a personal guarantee.
yeah.
So they're sort of getting around it.
Yeah.
But it's still good for distribution again for the for getting
family.
back to the families,
Yeah.
for kids
Yeah.
who are
and not just for
minors.
and not just the kids, but also the adult kids.
Yeah.
Because
On low tax rates.
Yeah, the minors get basically equivalent of
$416, 66% after that.
Yeah, it's
ridiculous.
negligible. Well, it basically brings it up to the 47%
Well,
bracket. That's what it does. It's a catch up. Yeah.
Well, that's the little loophole they fixed up in the trusts.
Yeah, a couple $100.
Yeah.
But trust can also distribute to
anyone,
siblings, and even retired parents as well. If they're not taking the pension,
can go into a company called as well
and a company
bucket company.
Bucket company. So lots and lots of different ways.
And again, you've got to do that modeling to see which one works out the best. Based in cash flow, taxation, and at the end of the day, the estate planning outcomes of that.
Exactly.
So you got to understand the outcomes of that, because there's different, as you were saying earlier, passing on different assets.
Yeah.
There's different ways you can do that.
Yeah, which we'll talk about in the next, the part 3 of the series.
Part 3, yes.
Yeah, but I think we do have to mention that at this sort of midlife phase, you also need to think about not just your own retirement, but the retirement of your parents as well. Because, as they get older into retirement phase, into aged care, there's lots and lots of things that a financial planner can assist with. Not just for the individual, but for the parents. And I think we might have had a couple of people who actually came through because they needed planning for
and the broader family.
The broader family.
Yeah. It sort of encompasses, because then you're dealing with the emotions of all the rest of the family, the siblings, for the parents and what have you, and then what's best for mum and dad. We're helping some people out now with that type of thing. It's really emotionally draining on them. That they get so much peace of mind knowing that here's a few different options we've got for you.
And it's having that third person as well.
Yes.
Because,
the objective person.
What eventually happens is that there'll be one sibling that will be the initiator and trying to take the reins on everything. And then all the other siblings like, oh, why are you doing this? And then they start throwing shit around, and it just gets very, very ugly very quickly. And having that, I guess, emotionally removed person from that family dynamic to be the arbiter, and
because you've got no emotion involved.
You're providing a service.
Well, you're just focusing on what's the best numbers for someone. And keep consideration the care of someone, obviously, but you don't have that heart emotion influencing your recommendations.
And that childhood.
That's right.
Because that's what I always say for a person to really become an adult, the first thing you gotta do is forgive your parents, and then the second part is forgive yourself.
I like that.
Because there's a lot of things that are probably not ideal. I mean, nobody's childhood is perfect. Nobody. I mean, anyone who tells you their childhood is perfect is lying. Yeah, and nobody is perfect themselves either. And if anyone tells you that, they're lying.
A narcissist.
They're narcissists. That's right. So in my frame of mind, the first thing you got to do is you got to forgive your parents, because
they tried their hardest.
They did the best.
I hope they did.
They did the best they knew how to. And when it's your time, you do the best that you can for your kids. And I was just watching this HBO series, The Last of Us, and I think Joel, who's one of the protagonists in the first season, that was killed in the second season. I think his father was a bit abusive, and the father said, "My father was, or Joel's grandfather was abusive," and said, "I did better than my dad, and you will do better."
Oh yes.
Yeah. So hopefully each generation you do better. And better.
Yeah. Become more self-aware and conscious,
and you forgive.
Yeah.
Yeah.
Well, anyway, just on that, when do you get time to watch TV?
I do.
3 a.m. Between 3 a.m.
when I'm broken and lying on the couch.
4 a.m.
I do get a little off time every now and then, but and that really resonated with me because as I said, every parent would have had their flaws growing up. There will always be that discontentment, and it's about in this situation when we talk about retirement, and maybe sort of inheritance, advanced care directives, and that sort of stuff, and who should be the one that is the designated person, that can get very, very nasty very quickly.
Yeah, absolutely.
If there wasn't an objective third person there, guiding them along the way. And I think that's another
without the agenda.
Aspect. Yeah. Oh, yeah. Absolutely. Yeah. Without the emotional baggage as well. So. Because most people have some form of emotional baggage when they talk about their parents.
I want this more than you. I should get more than you.
Yeah, exactly. Or, so, I stayed with mom when, she was unwell and now she's in a nursing home, so I deserve more. Oh, there's so much to it, right? There's just so much to it. So having, an advisor to guide them through that process, especially when the parents' retirement. Yeah. And then, letting everyone come to the table in an open fashion. I think that's valuable.
And what if scenarios? What if? Oh,
that's what we're here to do. Yeah. And what if mom needs to go into a retirement home earlier? What if they had a stroke?
This property, they'll do that.
Exactly.
How's that going to affect our aged care? How's it going to affect our means test? All that type of stuff.
Exactly. And there's so many things in at the retirement stage, in the aged care planning stage, such as if you sold a property to one of your kids, that there's this granny flat, then they live in there. There's these granny flat allowances, which basically has a lot of tax concessions associated with it, and it doesn't impact on their age pension if they qualify for that. And there's so many things. I was looking at through the study material for that sort of stuff, and it was way more complicated than anything else.
Studying, yes. Because you got time.
Yeah,
because you don't watch TV.
I don't watch TV. Well, now I do.
No, that's right. I mean, simple things like if you're the carer for your parents, we'll say they live with you in the house that they bought, and you're eventually going to inherit it anyway. But if that parent goes to retirement. That house is exempt, I should say, right at that point in time. But then that parent goes into the aged care, then that house is now becoming, after 2 years, I think it is something like that, 2 years, it becomes non-exempt.
Yeah, because it's an asset that can generate income technically.
Yeah,
they're no longer living in it.
Yeah, that's right. It's asset tested. So, there are things that you can do up front, like we're dealing with someone now, like we're talking about. It's something. Maybe is it better if they potentially gift it now? What do those figures look like? So we've run those scenarios. If they gift it now, because if you gift it now, it might knock you out of being able to get age pension for 5 years because it's called a deprived asset for 5 years. And after 5 years, then it's like it's a clean slate. And do those numbers look better? And in this case, they did. If they took the hit now, they get much more age pension in 5 years' time, which takes 2 years to make up that 4 or 5 years they lost in age pension. So you just got to do the numbers. You got to get someone to do the numbers. Because there's a lot of little things you got to know.
There's little tricks and quirks everywhere. And I was just looking at this. It's like, how does our with our aging population, how does anyone navigate this stuff? I mean, us as medical professionals, we don't even know how the age pension works.
That's another
we're putting people.
For you. That's right.
We're putting people in the nursing homes because you can't live at home because
you're just looking at the medical care.
We're looking at the care, right? You can't get the care you need at home. We're not looking at the finances. No. And then they go into the nursing home and holy moly, it creates
costs that much?
So much drama for the families, and they have to navigate that. And
again, with the new legislation, the more you earn, the more you pay. The more assets you got, the more you pay. It is a bit of a minefield. So it is a bit of a specialist area.
Yeah, absolutely. And I almost want to do one episode just so that we know as practitioners what's happening, and so we can have some resources for even for our patients, because I've got friends who are geriatricians, and they were like, oh yeah, they understand bits and pieces of it, but not the whole picture.
Yeah, and that's more my mindset is if I don't understand something completely, I won't make a decision.
Yeah. Oh yeah.
And then you procrastinate, never get it done. So I just go to someone who knows all the answers.
Yeah. Yeah, and I think that's another aspect that is often undersold because we don't talk about financial advice in that regard. It's always about, most of the time we're talking about the accumulation phase.
Yeah.
Oh, what do we invest in? Where do we put it? And that's really it. But there's just so much more to what you can do.
Well, the retirement population is accelerating right now. In the next 5 years, there's just this magic, a phenomenal amount of people retiring or going into retirement homes.
Yeah.
In the next 5 to 10 years, it's just rampant.
And I guess the topic for the part 3 will be what happens then.
Yeah.
So looking forward to have that discussion in the next episode.
Yep. I'll see you then.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.